A lot of high-income people think like, oh, retirement accounts, because they're like, I make so much money. Why would I can put $6,000 in an IRA.
Wrong. If you're a high wage earner, you wanted to be in Roth Gamma Gamma Chi party, you wanted to wear a toga outfit, you wanted in the party, but you made too much money, you couldn't go in the front door. So you had to go around to the back door to get into the Roth party. You can do that. Your financial advisor is wrong. I cannot emphasize that enough.
You talk about investing over 10, 20, or 30 years. The difference in that is incredible.
This is how the rich get richer, because you start plowing away 80 to 100 grand in a Roth IRA and boom, you're sitting on $1 million.
Welcome everyone to the Directed IRA podcast. This is Matt Sorensen, joined by the incredible Mark J. Kohler, and we are going to talk about
Rich people.
Rich people. This is for you, okay? And we always are talking about people trying to, make their first contribution to a retirement account, but I want to talk about maxing it out for high income earners, why you should do it, and also the order that you should do it.
I like it. Maybe if you want to be a rich person, this is what to do too.
Yeah.
This is, we hear so many of those influencer podcasts, right? All of us see it where if you want to be rich, do what the rich people do. All right, we're delivering. Here's what rich people do. So I asked Matt before, I go, you got a decision tree on how a 1%er, high income earner should consider what to do when it comes to retirement accounts. And you said, I go, can I see it? He goes, it's up in my head. I said, oh, really? Okay. Well, we're just going to explore that little decision tree chart, and I might debate with you a little.
I do actually have a decision tree chart, and you have to be following me on social media to find that. But I'm going to display it for you, or I'm going to roll it out for all the podcast listeners here. But here's why I want to talk about it, though. When you put money in your retirement account, it's tax advantaged. And I'm not even getting into traditional or Roth. We can talk about that. We talk about a lot of episodes in the podcast, when to do which, and we love Roth in general, but we're not even talking about that. I'm just talking about getting money in. A lot of high-income people think, particularly our high-income earners, or even our entrepreneurs, like, oh, retirement accounts, because they're like, I make so much money, why would I can put $6,000 in an IRA. They have all these misconceptions.
Correct.
That it's just not going to move the needle much. But wrong.
Okay.
When you add it up, it's a lot.
Yep. Number 2 myth or misconception is, well, someone said, I don't want to die with too much in my retirement account, or I should use life insurance now, or I should go over to some alternative method. Now, we're all for diversification. I love rental real estate, notes, alt assets. We just held our alt asset summit.
Yeah.
But you can do a lot of those investments. Now, let's not talk about life insurance per se. I'm not saying life insurance is bad either, but we've got to continue to stay committed to pass and go on our Monopoly board every year, putting money on our retirement account, because that snowball grows so much faster than we realize. It's just out of sight, out of mind, and it's okay if you die with money in your freaking retirement account. It's going to go to your spouse or your kids. It'll still be tax preferred, so get over it.
Yeah, and let me just make sure you understand this. You could be putting in over $100K a year. We're not talking about
easily
just like $5,000, $6,000. Okay, we're talking about over $100K a year into your retirement account. Even if you're a W-2 employee, I'm not talking about you have to be self-employed to do this, which a lot of our amazing tax strategies work best if you're self-employed. This is even you're a high-income W-2 earner. This can work. So let's break it down.
Okay, last point, may I?
Okay, yeah.
Last misconception is, well, I don't want to put money in retirement accounts because I'm going to be stuck in Wall Street. Now, if you're listening to this podcast, you already know. We would assume that we've busted that myth. You're going to be able to invest it in whatever you think is best for the best rate of return. But okay, so those are 3 myths out there. Okay, so Matt Sorensen, I'm a high wage earner.
Okay.
I work at Verizon. I work at IBM. I work at Facebook. I'm going to have a big fat W-2. What should I do first, according to Matt Sorensen lore?
Okay, first I want you to match an out. I want you to put in as much money in your 401k to go and get the match. Let's say you make $200K a year. Okay? Let's say you make $200K a year. Well, you can put in, and let's say that you work at Facebook, and let's say that Facebook has a 4% match. They say if you put in 4% of what you make, which would be $8,000, we'll put in 4% of what you make, $8,000. So now I'm at $16,000, and it only cost me $8,000.
So I got a 100% return.
100% rate of return on my money.
Boom, that's an easy one. Even if they invested in crap in Wall Street, you're like, no offense, my financial investment advisors and Wall Street products. I have Wall Street products too. But even if they choose something terrible, I've already doubled my money. Okay, that's number one. I want to write that down. Number one, get the freaking match.
Yeah, and we tell this to every client, whether you're middle income, high income, this makes sense for everybody. Match and get out. The difference here for high income earners is we got a lot more steps and buckets to drop money in.
This is step one. Okay, can I throw out step two? I want to see if this fits in your model.
All right,
okay, step two, fund your personal Roth.
Yep.
That's your number two?
That's number two.
I nailed it? Okay. All right.
Mark said, is this the Mark Kohler approved method? I'm like, this is the Matt Sorensen method, but pretty sure it's going to be the same.
Okay, fund your personal Roth. But Matt, my accountant said I make too much money.
You do make too much money, and we said $200K in the example. You're over the standard Roth IRA contribution limit, so you can't just drop $7K in a Roth IRA, but you can do $7,000 in a backdoor Roth IRA. We've got separate podcasts, videos, a lot of training on that. But it's basically a way you put money in a traditional IRA, non-deductible, and you convert it to Roth. At the end of the day, you're doing $7K a year Roth IRA.
Yeah, let me just put this on a practical note. If you're a high wage earner, you're old enough to remember Animal House with Jim Belushi. You wanted to be in Roth Gamma Gamma Chi party. You wanted to wear a toga outfit. You wanted in the party. But you made too much money. You couldn't go in the front door. So you had to go around to the back door to get into the Roth party. You can do that. Your financial advisor is wrong. I cannot emphasize that enough. Watch our podcast, check out our articles, just Google Backdoor Roth IRA Sorensen or Backdoor Roth IRA Kohler. We'll give you everything you need to know about how to do it. So that's step two. Now, I'm going to throw out step three. I want to just see what you're saying. At this juncture,
I thought this was my list.
I know, but I just want to say, okay, all right, you tell me what number three is. I think I've got a number three that's going to blindside you.
Oh, really?
I do.
Okay.
What's your number three?
My number three would be, okay. I'm going to do the HSA.
Wrong.
Number three.
So you're already wrong. See, you know what I do? Spouse.
Spouse backdoor Roth IRA?
I'm just saying. I'm like, I think at this juncture, before you go HSA, I love HSA though.
Okay. We didn't say we were married.
Okay.
So let's go for you married. I like where you went there.
Yeah.
Spousal backdoor Roth IRA. That didn't sound right.
Do not repeat that again.
Let's just say you get another $7K because you have a spouse. Your spouse is going to also do the backdoor Roth IRA.
I'm trying to refocus here. We're going to talk about the sweet spot on the 401k too, but that's another topic too. Okay, so no, but I think if you're married, I love the HSA, and I'm going to go with HSA. I'm with you on number three. But I think if you're married, you've got to look at your spouse. Okay. Do they have a day job with a match?
Yep.
And have they funded their personal Roth? I think times two here.
Yeah, and what I would say, and this is why I would think about it individually. If you're married and you have a working spouse, we're pretty much doing the same damn list over on their side too. We're going to go in the same order there. Now, they might be a different income than you, so there might be a little difference here. But okay, so let's do this.
Okay,
same spousal backdoor Roth IRA.
You know what? I'm just going to throw out a little digression here. What do you call it when you go off the freeway here for a minute? A little side note here. What's the word?
Not a diversion, a detour.
Little detour here. Little detour. I just want to throw this out. Matt and I have the love of our lives, Michelle and Patty, and I just want to throw this out. This week, Patty and I are having an afternoon retreat planning session to go over these things before year end. And I want to say this. I think this is an important emotional piece of this process. You can't just decide this in a vacuum if you are married. Yeah. I think it's so important you take your spouse, whether your husband or wife listening to this, and do a little off-site retreat, go to a spa, go somewhere fun, and just say, let's talk about our retirement accounts. What are our current balances? Mm-hmm. What can we be doing together? I'll tell you right now, your spouse is going to love that. Because they want to be a part of that conversation. And I know in some relationships, the woman's doing all the financial planning and the man's doing all the financial planning. But I think this conversation, especially when you're determining this order, it's a great opportunity to plan together so that you understand why you're doing this. And it can be a real bonding experience.
Yeah. And I think you're going to be more successful, encouraged, collaborative, better at opportunity to meet all your investment goals and retirement goals if you're doing it together. So I think that's a awesome recommendation.
Little detour there is okay?
For sure, yeah.
Okay, number 4, drop it. I love it.
Okay, number 4, we're going to do the HSA. Okay, health savings account. Now, some of you might be thinking, Matt, you said for retirement accounts. I want you to think about your HSA as a retirement account, not really as a health savings account, because the HSA, I don't have to spend the money in it. Remember, I put the money in, I get a tax deduction. As I invest it, it grows, and I don't pay any tax on the investment gains. But as I pull the money out for medical and healthcare expenses, there's no expense on the way out. There's no tax on the way out. At any age. Now or later, where if you're looking to really maximize money for the long haul in retirement, don't draw on that HSA yet. Leave it for later because you can use it later. The number one expense you're going to have in retirement is medical.
Damn it, I was going to say that. Okay. I'll say this too. The number one reason for bankruptcy, medical.
Yeah.
We just had a Medicare Medicare training for our Main Street Tax Pros 2 weeks ago. I called you after, didn't I?
Yes.
It was unbelievable.
Yeah.
The Medicare.
I got some learning to do.
Oh, it's a blind spot for me, or was. But one of the takeaways from that is the average American spends, after age 55, over $350,000 on medical. Average. Now, whether your insurance is covering the bill or not, or Medicare is not, you're going to have a six-figure times 3 medical bill between 55 and date of death. And how are you going to plan for that? So anyway, I think the HSA is number 4, again, times 2 if you're married. And we've done podcasts and trainings on the HSA. And if you're listening to this podcast, guess what? It's open enrollment. Open enrollment started November 1st. It's so important that you choose at your company or in your individual plan, if you're an entrepreneur, a high deductible plan. If you have the high deductible plan, it unlocks the HSA. We've done so many shows on it. I think it's one of the best kept secrets in tax planning. I really do. I think the HSA is critical.
Yeah,
I like that it's number 4, again, times 2. All of these we're going to say, I'll just say it from now on, I won't repeat it. Times 2, if you're married, you're going to be going through the same lineup.
Yeah. And so let me tell you where we're at here in terms of total numbers. We said you did $8,000 to get the match of an employee contribution. Your employer matched at $8,000.
And it could be 10 grand or 12 grand. We don't know.
I'm just doing one freaking example. You're making $200K.
Yeah.
And then you did $7,000 in the backdoor Roth because you're under 50. If you were 50-year-old, you could have done $8,000. Now, let's say you did the family HSA because you have a kid or a spouse, so you can do family. That's $8,300. We're at $31,000 so far, and we're not done yet, guys.
Is that 31 times 2 or just 1?
That's just 1. So if you got a spouse, we're at 60.
60 plus thousand.
Now I did do the family HSA, so, but you're pretty much about 55.
See, and this is, I know some of you might be a little. I'm going to use a word my mom would use. I am so galled. I'm so mad I could spit. Some weird thing my mom would say. But I know some of you are like frustrated because we are in a tough economy right now. I know that there's many, many people struggling with the cost of groceries, the cost of gas and transportation and housing. We get that. But there still is, I hate to say, this 1 to 5 or 10%ers out there that are like, hey, I'm paying a ton in taxes and I'm flipping the bill for the rest of the country. I want to save some taxes. Well, these are tax deferred or tax free type strategies. Some of you may say, well, I don't get a tax deduction for a Roth. Yeah, but you'll never pay tax again. Don't get hung up on getting the deduction. It can also be a plan to build a bucket that will be tax free. So anyway, I just wanted to, as a digression, say, don't be too frustrated or offended with our cavalier attitude towards putting this away this much money. But when we have clients that have $500,000 W-2s and small businesses, they want to know this. It's so
when I was broke, I wanted to know this, and I didn't feel offended or anything like that. I'm like, that's just where I'm going. That's the mindset you should have, is that's where I'm going to be going. I need to know this for the future. The other thing I would say about this, I think a lot of people think, well, why don't I just put $30,000 in a brokerage account, Matt? Why don't I just invest $30,000? Why do I got to put it in my 401k, and then I got another account over here, then a Roth IRA, got an HSA? Why am I doing that? It's tax advantaged, okay? You're either getting a deduction to put it in, or that money grows and is coming out totally tax-free. In any event, though, when you're making investment gains, it's not going on your 1040. You're not paying taxes. Every dollar of investment gains you have in these accounts gets reinvested. When you talk about investing over 10, 20, or 30 years, the difference in that is incredible. Okay, so you get a huge head start and boost by using these tax advantage accounts versus just dropping it into a taxable account.
All right. Now I'm going to throw out number 5.
What do you
I'm trying to use you. If you listeners are here, I'm trying to throw Matt a curveball here. All in due respect to the Dodgers who are up 3-1. But anyway, so I want to
I think they've proven they can hit a curveball.
One of the major drains on a couple's retirement savings plan is college savings. So I would say if you really are 30 to 60 grand in, you've done your match, you doubled, you did your Roth, you did your HSA, I think it's a time to just sit back and go, okay, do I have children under age 18? Am I trying to do a college savings plan for them? And I'm not saying throw every dollar that direction, but at least decide, am I going to fund the educational savings account, which is like a Roth IRA for education? Am I going to do Roth IRAs for the kids, hoping that they can pull that out for college? Should I look at a 529? We've done many podcasts on that. So I don't know. I think, would you divert a little and go look at college saving?
I like to wait on college savings for kids. I want to come to them later. They're definitely in the order here, but for me, they're a little bit later because I think you need to put more money in your retirement.
You got to put your own oxygen mask on first.
You got to put your own mask on first. Every good flight attendant knows that. So, so we want to put your own mask on first. Now, if you're like, Matt, I've been saving my retirement account for a while. I got $1 million plus in this. I'm going to continue to save and doing this $30K a year. And I got kids that are 10 or something, and I want to start setting aside for college. Cool. I'm good there. If you're under $1 million and you got kids, I'm not doing this yet.
They can go to community college.
Let me say this. Mark and I have done a show on this. You need to be at $2.5 million in your IRA or 401k to retire. If you don't have that much money in your retirement account, you don't have enough. And you know what we did? We did a survey with our directed IRA customers, and we said, how much money do you think you're going to need in your IRA or retirement accounts to retire? And I had options, 250 to 500, 500 to $1 million, $1 million to 1.5, 1.5 to 2.5, 2.5 million or above. Do you know what the majority answer was of how much they thought they needed in their retirement?
Let me get under $1 million, probably.
No, over 2.5 million. They said we need to have over 2.5 million in our retirement account.
They shocked me. They went to the proper answer.
It's because they know what's up. They're listening to the Directed IRA podcast, listen to Mark and Matt. Okay. But you know what? The follow-up question I asked in the survey was, how likely do you think it is that you will meet your retirement goal? Okay. That was the question right after this. Oh. What do you think the answer was?
Oh my gosh! I would think
and
it would be.
I gave him an answer. I said,
multiple
not
choice.
likely, somewhat likely, very likely.
Somewhat
likely. No. Okay, you've got to have more faith in our customers. The vast majority of answers said very likely. They felt it was very likely that they could hit that retirement goal of $2.5 million.
Jeez. Matt Sorensen, you're doing your job. You're changing America.
I was like, wow. I love those numbers, but the point I'm trying to make there is really assess and be realistic where you're at. I think the impulse is, I want to help my kids go to college. It just makes you feel good. It seems more tangible. It might be 5 or 6 years away, and you might have retirement 20 years away. And so it's like, I better start saving for it now. I'm still like, let's make sure you're maxing out your retirement. And make sure you're on track to be at that 2.5 million, adjusted for inflation too, by the way, in your 20 or 30 years.
All right, well, it goes back to I'm not going to trust any polls during this cycle. Okay. Okay. All right, so I do my HSA, Matt. We're going to I'll put college savings off to the side, depending on where they're at. This brings us to the concept of match and out. So I got my match. I went out and did a couple things.
We did the out.
You're coming back home now.
We're coming back.
All right, tell me where we're going.
All right, we're coming back to the 401k, and we're going to do an after-tax contribution.
Oh, well, whoa. We're going to still do our deferral amount, up to our deferral.
Well, that's true. I only did 8K. Okay, let's finish the employee deferral, and that is actually on my list, by the way. Okay, let's finish the employee. We only did 8,000. So as an employee under age 50, you get to put 23,000 total into your 401k. Now remember, on step 1, we did 8 and the employer match date. So I've got 15K left of employee deferral, which you can do as Roth, pretty easy. So let's do that first. That's pretty simple. So now I'm at 46,000. By the way, if you're following on the math here, we're at 46K because I was at 38K after the HSA. I did another 15K, which you could have picked to do traditional Roth. Now we're up to 46K.
Okay. Now, a couple thoughts, if I may. For those that are 50 or over, it's $30,500. If you're under age 50, it's $23,000. And I'll say it a little where I know sometimes I get comments from listeners that are like, "You guys do this all the time. You talk too fast." So, okay. All right. Well, I want to slow down and say this. You've done a match, got the company match. You went and funded your personal Roth. You went and did your health savings account. You're coming back to the 401k, and you walk into or call up your administrator at your company if you're an employee, and you say, "Hey, I want to change my withholding on my paycheck and get it up to the complete deferral for my age." So they'll go, "Oh, okay, well, there's 8 months left in the year, there's this." And they're going to go, "Okay, that'll mean we're going to withhold X dollars from your paycheck for the rest of the year to get you up to the 23 or the 30,500. And you say, "Yes." They're probably going to have you sign something. Then boom, you've got your deferral amount. That would be stage 5 here. Same for your spouse. Now, this is where I talk about the sweet spot also, because if you're an entrepreneur and you are a 1%er, high income earner with a small business, you're going to be able to still do this. It's not going to be prohibited from a overweighting testing thing, that you're
highly compensated employee rules.
Yep, you're going to be okay. Even if you have a safe harbor plan, you can still do this part. You got to play with the match like all the other employees. You can't really sock away some major money. We're going to come to other ideas in a moment. But if you're an entrepreneur too, this is where you're going to put your spouse on the payroll for the exact amount to get this deferral. So approximately, if your spouse is under age 50, you'd put him or her on payroll for about $25,000 and change. FICA hits, the net paycheck's 23. You drop that in Roth or traditional. You're off to the races. So you can choose a lower payroll amount for your spouse if you can control that narrative. But again, if you're both W-2, corporate America, you're just going to...
Your spouse is doing the second thing, exactly what you did.
Yeah.
Let me say one other important point on that, on the 401k, is many 401k plans and administrators will just say, you can just make a one-time contribution yourself. You can just mail in the check or ACH it to your 401k.
True.
It doesn't have to necessarily come from your employer. You want to
coordinate.
Paycheck. Yeah, they actually and withheld from your paycheck. That's usually the easiest. But if you're like, well, I've got 10K left to put in on an employee contribution, and it's December, and I'm not going to have a paycheck that high where they can withhold the whole thing, you can throw the payment in directly.
This is a great year-end strategy because you may go, well, I don't have enough payroll left. That doesn't matter. Go take it from your inheritance from grandma 2 months ago. That money can come from anywhere. Go into your HR department and go, here's the rest of my deferral, put it in.
Yeah.
They don't care where it came from because your paycheck for the whole year is going to be greater than that.
Exactly.
So it doesn't matter what your November or December paycheck is. Great comment.
Okay, so step 5, we finished our employee contribution. We had 15K left. Now we're up to 46K. And again, we're doing under 50 numbers here. And just your spouse can come do the same thing here next.
Okay, number 6, my friend.
Now we're to where I was wanting to go, which is the after-tax employee contribution, because you get to go up to $69,000. Again, this is under age 50. You get to go up to $69,000 of total money in the 401k. So we got to look at where we're at. We just maxed out the employee at 23K. We got an $8,000 match earlier on step 1. So now we are at $31,000 in the 401k. This is your day job 401k, your high income earner. I've got $38,000 left that I can put into the 401k. But I can't do an employee contribution. The company's not doing any more match. So how do I get it in? This is the after-tax employee contribution. You can put in. Most plans allow for this. We've had many clients that have been at big companies, many different varieties, dropping this in. This can roll out to a Roth IRA. Even though most 401k plans, your money's locked down, this is one that can actually roll out the after-tax employee contribution.
Okay, now I want a couple thoughts for everybody. Write this down. I know if some of you are driving down the road or on a treadmill, you have to know this term. I bugged Matt's for years once we learned it, because if you say it wrong, your employer will jack it up. It's called an employee after-tax contribution, which in a sane world, no one would ever do. let me tell you how we learned this. I think to put some context to it. Matt, I remember almost where I was at when Matt called me and said, dude, I just learned something so cool. And we learned it from some clients, a very unbeknownst client. So we had a bunch of guys up in South Dakota.
Alaska. They were in Alaska.
Oh, that's right. They were in Alaska working in trailers, doing natural gas drilling, oil drilling, la. These guys have all their housing paid for, all their food. All they do is get drunk on the weekends and go back and work on the oil rig. And so they've got these big fat W-2s. And in this, I'm keeping it to the point here, they were the ones that said, yeah, we're doing this after-tax contribution because we have so much money. We wanted to keep putting money in our 401k and then convert it to Roth. Can we do that? That's what we've been doing. Please verify. And we're like, what the hell are you doing? So in a nutshell, they called their HR department and said, yeah, I did my deferral for 23. I may have did my Roth personally, but I want to put more in the 401k. And the company said, okay, you can do that, but you don't get a deduction for it because you've already done your deferral. And they say, that's okay, just put it in. I'm going to convert it to Roth anyway on day 2. And the employer's brain explodes. The client's like, am I crazy? And they call us.
Yeah.
And Matt Sorensen verified for them.
Yeah.
You can convert this to a Roth on day 2. And so basically it's like a supercharged backdoor Roth.
Yeah.
And in your example, it's like $38,000. Just
right there. That was $38,000. And I do remember these guys. They were at Fidelity, and we did it there. And this is around 2014. There was a case that came out, and then kind of like a revenue ruling from the IRS that validated this, that said, yes, you can put more money in up to the 401k total, deferral and maximum limit, which is now is $69K for 2024. And it can also roll out to a Roth IRA, which was the key because they didn't take a tax deduction. See, it's after-tax dollars, meaning you already paid tax on it. You're not getting a deduction, but it is going. It can then roll to a Roth IRA with no conversion. You don't need to convert it because it's already after tax. You didn't take a deduction on it. So that was a cool strategy and where we kind of picked it up. And this 2014 or whatever is where this kind of new strategy came about. And this has been coined the mega backdoor Roth 401k. Not to be confused with the backdoor Roth IRA, which is a little different procedural steps. This is the mega backdoor Roth 401k.
And to put a very tactical twist on this, between now and the end of the year, you would call your employer and go, I want to do an after-tax contribution. And again, you're probably not going to have this with W-2 wages. So you've got to show up with a check. And that money can come from anywhere. It could come from rental income. It could come from your stock brokerage portfolio. It could come from your grandma that left you an inheritance. Doesn't matter. So you'd show up and make this contribution directly to the 401k plan, work with your HR administrator, and then you're able to roll it out again into that Roth. So this is just incredibly powerful because now we are pushing close to 80 grand. And if you're over age 50, even more. And then you're married times 2. Holy crap. This is how the rich get richer because you start plowing away 80 to 100 grand in a Roth IRA. We're putting your HSA in the mix here too, but you're putting that money away every year. It's not just a few years with a good ROI of 10 or 15% self-directing this. You're sitting on $1 million and boom. And for those that are in your 50s or 60s and scared to death about retirement, and you're like, how do I catch up? This is how you do it.
Yeah, I love it. And if for any of you, we're actually doing math here. We're at $84,000. Okay, $84,000. You don't need to be self-employed. You don't need to do a DB plan or a pension plan or these crazy strategies. We're not bringing in whole life or anything like that. We're just talking about tried and true retirement accounts, 401ks, Roth IRAs, health savings accounts. When you add up these buckets and you're strategic about it, you can get $84,000. If you're over 50, this would have been in the $90,000. And like Mark said, if you're married, we're talking like $180,000 a year in contributions that can be saved in a tax-advantaged way. That's the secret sauce.
All right. Now that would be number 6. Oh, pen drop. There we go. I'm joining the crowd here. All right. Now number 7.
Oh, we're not done yet?
Oh my gosh, no. Okay, now you get into cash balance plans, 401h, and DB plans. Yeah. Now we could put those all in one bucket, rather than break those down. But we have
if you're self-employed.
Yeah, and so fair enough. Or you have a side hustle.
True.
You or your spouse. Yeah. And so now you're saying, I've got some additional income with consulting, a 1099, or you're self-employed. I've done everything I can with my 401k, Roth, and HSA. What more? And so we have financial advisors that we work with in our Main Street Tax Pro program. We teach this at our 360 conference. We have a whole class on what to do for one percenters. Mm-hmm. We're getting into solar. We're getting into oil and gas. We're talking 1031s. We're talking equipment and real short-term rentals and cost seg. We're trying to find every write-off we can for you, but you're going to get into, I'm going to call it cash balance, DB, or 401h. Still not the life insurance route.
Yeah.
These are all deferred comp plans, and you could do $200,000 or $300,000.
Yeah, and that's taxandlegal360.com.
Yes.
That'll be here in Phoenix in early December. Mm-hmm. And you know what's awesome about all the tax strategies and savings there is that's the money, if you're doing it in a tax advantage way, you can be dropping into these retirement accounts.
Yeah.
Because all that money you're saving on taxes. So, but I think those last ones work for self-employed. And if you are self-employed, you might have been doing a solo K in this process. And we should probably do an order for self-employed people because it is a little different than the high-income W-2 earner. It's frankly simpler because we're like solo K, backdoor Roth, HSA, you got a spouse, we're doing the same thing for them. And if you're over this 80K-ish, because you end up at the same 80K-ish at the end of the day, we're looking over here, and maybe you should have just done a cash balance plan or a DB plan where you could be doing $300,000 a year.
Yeah. And let's, big picture, as tax advisors, which all of our attorneys are, if any of you are feeling like, holy crap, my accountant, my tax lawyer, my lawyer, and my financial advisor is not talking like this, please do what we call a comprehensive tax and business consultation. You can go to KKOS Lawyers, work with any of our 12 to 13 tax lawyers now, and they'll get on a call and spend several hours building a plan and then delivering with a diagram and a checklist. Then you can take it wherever you want. I mean, we're talking a few $1,000s. We're not charging these big $20,000, offshore crazy retainer crap for under $5,000. And that's for the highest net worth individual. Many of our clients are doing this for $1,500 to $2,000. Just getting a consultation where you build a plan that you can build upon. And we're going to save you 10 times that in taxes. So get a consultation, come up with a plan. And when you're looking at the big picture, we're going to talk real estate. We're going to talk about setting aside money for rental property or some other types of investments, maybe life insurance. It's not all retirement accounts, but I think this is where it starts because it's asset protected. You can choose the investment. You're not locked into premiums.
Yeah.
There's just so many good things.
Yeah. So now directedira.com, we do a lot of these accounts at directedira.com. You need the backdoor Roth IRA, the HSA, solo K if you're self-employed. We can definitely help with the accounts there. So, but whoever you use, whether you're working with us or you're doing it on your own or different companies, we want you to use us. Our companies are amazing. We got an incredible team. But I just want to make sure you know you can maximize this. We're not just talking thousands of dollars. We're talking 84K there in that example that we gave. That can be tax advantaged, can be money working for you, helping you build your financial future.
Okay. Well, Matt Sorensen, I guess I will give you a stamp of approval.
Thank you.
On your decision tree.
Mark Kohler certified?
Yep, certified decision tree. I think we really flushed it out there. And thanks, everybody, for listening this week. Please give us a 5-star. Share this podcast. There's so many people that are starving for this information. You're actually doing a wonderful service to others to help spread the good news about the ability to use retirement accounts and invest them in what you know best. We're grateful to have you as part of our podcast. Thank you so much for listening, and we'll see you next week.
See you next time.